Hello, folks. This is November 6th, 2 days before the election day. As promised, I'm going to give you a slideshow for public pensions, accounting, and finance. This is going to be break down into two parts. This is part one will be some basic knowledge, and part two will get more into some technical issues. Excuse me. Let's look at the most basic problems. What is the most basic questions? What is the pension and what is the pension plans? You see, a pension is just a deferred compensation. It means that something, the money that you already made, and but it's not paid to you. Why? Because they'll wait to pay you when you're retired. So that's what's called deferred compensation. It's no doubt that you already earned it. You by your service, um, the money should be paid to you. There's no question about it. And so that's why you already the service is already there. You earn. You are the owner. You have the right to everything for how to spend on it. And so this is what a pension is. So what is a public pension? Public pension is basically including two major parts. It's a state government or local government, like city, Berkeley. Those are the government employees. Sometimes the school teachers they're counted as a part of the um, public pensions because they are hired by the government. Um, so those are the two things: pensions and the public pensions. And here I want to emphasize that employees and employers, employer and employee. Then when you hear the word employer, it's not the same thing as everyday language. It's not saying that the chairman of the board, the CEOs, they are the employers, they're the boss. They're not the employers. Okay, when we say employers, it means that it's more like an institution, not a person. Okay, so in other words, the same pension plan may cover the CEO, it may cover the chairman of the board. They are covered by the same plan. But when you say employees, obviously that's everyday folks like you and I, right? And then the important thing is that we have to separate the employers and the employees because they both contribute to the pension plans, but the way they contributed, they are contributing it differently in terms of money, how much money they contributed, and so don't confuse that employers is not the same as employees, as bosses. Okay, it's just the employer is always in comparison to the employees. They're not the person; they are institutions, they are entities. Okay. And then here I want to really like this slide that they give you the basic knowledge. It's so you can click on this link. You can to take a look at it. My slideshow it probably covers more than this guy. Um, in fact, my slide is basically my slideshow is divided into two parts. The basic parts, knowledge similar to this, looking at the big pictures, and but then also at some point I will look into the unfounded liability. That is something that people get confused. Um, they're worried about this, and then so I need to focus on this, and then this will get into more advanced stuff, and we'll see that later. Okay. Okay, so you might be curious that why all the pensions are always associated with the plans. So we always hear the pension plans. Why is always plans? For a simple reason that because all the pensions it's concerning about the money in the future. So that's why it's not the money today. It's not like a salary that they pay to you month from month, day, week to week from week. So because if anything that involved in the future, so you need a plan. That's why we call always you say pension plan. Okay, pension plan. Just remember that it's something about the future. But here I want to quote this definition from Investopedia. That's a pretty fairly decent. Fairly recent is September this year. Let's look at this. What their definition of a pension plan? A pension plan is an employee benefit to committed employers to make regular contribution to a pool of money that is set aside in order to fund payment made to eligible employees after they retire. So there's some problems with associated with this definition. First of all, a pension plan is not just committed to employers, because pension plan nowadays, we'll see some statistic later to show that not just the employers but the employees they both make contributions. So that's one thing that we need to notice. This, that somehow I think this definition is kind of missed. Forgot to mention that. And then the second thing is that not all pensions are pre-funded. What is pre-funded means that the employers make a regular contribution, like a month from month and week from week, right? Regular contribution, regular deposit to put the money into a pool, and then that money will set aside because that money won't be paid today. It will only be paid when you are retired. So this is a common situation. Yes, a lot of pension plans do set aside money, do put the money aside into a pool, and then that pool will be paid to the employees when they retire. Okay. However, that's not the 100% the case. Not all pensions are pre-funded. Some are pay as you go. So sometimes you see the PAYGO. PAYGO means that they pay as you go. So sometimes they put an O behind after G so you can pronounce that as a PAYGO. Basically, that's how it works on the Social Security. Have you ever wondered how the Social Security works? It's basically today's employee will cover the retirement benefit for people who already retired. So it's like it's a continuous game that whoever is working, we will make money, and then that money will be a part of money will be paid to people who already retired. That's how the Social Security works, and that's why Social Security is also known as a PAYGO system. Okay, so some pension fund works in this way as a PAYGO instead of putting the money aside and to be paid later. This is not a very smart idea, but um, we'll see that it does happen, especially in the past. Okay, so let's look at the overview, the big picture. This is notice that this is from publicplansdata.org, great website. So all the numbers here will be quoted from this website. You can check on that. From that, you can learn that there are a total of about 6,000 public pension system. Again, remember, public pension means that the state government and local government the pension plans, not the private pension plans. So for not including the private pensions, only the public pensions, we have about 6,000. That's a lot. And what are these? You see that about 300 are state government pension plans, and almost 6,000 are the local government pension plans, meaning a place like the city of Berkeley and the city Walnut Creek, the city of San Francisco. Those are the below the state government. They're called the local pension plans. And then some of they have a very long history. Sometimes that goes back to 19th century. So the pension has a long history in this country. Just keep that in mind. So how much are they accept? How much money do they have? It's a huge money. We're talking about the $4.5 trillion in asset, meaning that the money they have. And then just put this in perspective, the total U.S. Annual GDP is about 23 trillion. So there's 4.5 trillion. It's a lot. It's a huge amount of money involved. And then here, let's look at this two numbers. The first one is that we have a 14.7 million active working numbers. Okay, so this is how many people working in the public sectors, right? And I think this is this is a public data. So we only talk about 15 million workers who are still working. These people, like how many people retired, how many people is working? 50 million still working, 11 million retired. So this is good news. This means that for every retirees, we have more than one workers to support them. We are making money to support the payment of the retirement pensions. So normally you want this number bigger than this one. In China, pretty soon they will get into trouble that there will be fewer active workers than the retirees because the aging population, right? So in the U.S., this is a pretty good picture. Okay, and then there's another thing that how much money we're paying out each year. The number sounds like a huge $323 billion. Every year, that means that every year we will pay this much money to the people who already retired. Okay, this sounds a huge amount of money, 300 billion, but if you compare to the asset is a $4.5 trillion. Okay, 1 trillion equal to 1,000 billion. So basically, I did the math, and then I found that it's about 7% of the each year we are paying the retirement benefit. So it's a pretty nice picture. Okay. Okay, now let's talk about the number of people that are covered by public pensions. Basically, if you take all the state government and the local government, like city government, like Berkeley, it's about 14% of the U.S. population, working workforce, not the population, people who are working. So you can see we're a huge amount of people involved. Okay, and then this is a kind of a shocking. I don't know. Not everybody knows this. 25%, every one out of four public workers, public employees, they don't have Social Security. This is, for me, it's kind of shocking because I have Social Security, and Social Security, when people think about retirement, they want to think, oh, I got Social Security coming up that will cover my retirement. Bad news for the public sectors, public employees. A quarter of them don't have Social Security. That include almost 50% of teachers and more than 2/3 of the firefighters and public safety officers, like meaning the police. Okay, so basically the bad news is that the pension plans, all the money they got after retirement, okay, which is not a it's a kind of a risky situation compared to people who have the Social Security, but also pension plans from their employment. So basically, the pension plan works is the three things. One is that you contribute. Okay, you make money when you work. You deposit money, you save the money, just like basically like saving the money in the bank. And then you save this money. The money you saved will be invested into financial market. And then when you retire, you distribute it. You get the money. The money will pay it to you. So those are the three steps. Um, so this is how the what is the so-called pre-funded pension plan works. You when you're working, you contribute the money, and then this money you contributed will invest it, and then when you retire, you distribute it. Okay, and then here let's look at you know the last step is a distribution, which means that uh, where the investment going to where are the money go to invest to be invested. Here we look at the picture. Basically, 50% is the equity. When you think about the equity, you think about the stocks. Okay, and um, and then 21%, about 20% is a fixed income. When you think about a fixed income, basically think about a bond. Private bond um, or public bond. But basically, they are bond, meaning that you buy the bond from the government or from the private companies, and they for a certain amount of time, and then at the end of a bond mature, you got your principal back, and also they pay you interest. Okay. And then we also have like 11% of a private equity. Private equity, it's not the same as a privately held companies. A lot of companies, they are private company, right? Google is a private held company, a lot of many others, Apple's private company. But when we say private equity, we're not the same. We're not talking about the same as a privately held companies. Private equity, they are talking about investment companies. They invest money into company, and then um, the way they separate from the way they differ from um, um, the investment company, like a venture capital company. Venture capital company, they invest money into startups, and then when they start up, grow up, and then at the end of the day, they sell that the share and then get the money. But the private equity company, what they do is they invest in a mature company, so it's a lot less risk involved. Okay, so so this is just a quick note about the private equities. And then we also have 8% of real estate and 6% in a hedge fund. So basically, if you look at these destinations, you can see that, you know, previously when you think about the pension plans, you always say, wow, these people, that's their retirement money. So we should be very, very careful. We should only put the money into bond, especially the, federal government treasury bond. That's basically considered risk-free, right? But even you look at the reality, you see it's totally different. We have all with the money is everywhere. We have including the stock market, and also the fixed income, the bond, private equities, and especially 6% of a hedge fund, which are considered to be very, very risky. The return can be very high, but also risk is also high. You see you hear what they say, the no risk, no gain. Okay, so you can see that in reality, the people, the pension fund money is everywhere, just like any other investors. So bear this in mind, and we'll come back to this later. But meanwhile, when you look at the returns, returns is excellent return, meaning that how much money you get from the investment. You can see that in 5 years, it's about 11% that the gains, meaning that if um, if you invested in $100, you basically get $11 on top of the $100. So at the end of 5 years, your total will be $111. Okay, but if you look at the long run, like 10 years, that's about a 9% gain, and then 15 years is 7.1%, 20 years is 7.4%. 30 years, that's typical when we talk about long term. We usually talk about the 30 years. In the 30 years, the money they invested will get you like 8.7, almost 8, almost 9%, meaning that every $100 you invested today, after 30 years, you basically get $109 back. Okay, so this is some basic idea. And then here, let's talk about the two type of pension plans. One is called a defined benefit. So when you see the word DB, it means defined benefit. We have another type which is called the defined contribution, the DC, defined contribution. Those two are not the same. They're very big difference. Here, basically, when you look at the public employees, when you look at the public pension plans, almost 100%, 94%, they have the access to defined benefit plan. But although 93% offered this retirement plan, only 83% actually take it. So we have 11% of people who did not take it, did not accept it. They said, okay, we don't need this, which is not a smart thing to do. But anyway, so you can see that a lot of the public employees, a majority, more than 80%, they are participating in the defined benefit plan. So here, what is the difference between defined benefit and defined contribution? Defined benefit is like, when you say defined, it's like predetermined, okay? There's no negotiation. You have to pay, this government employer have to pay this money to the public employees, government employees. There's no negotiation. It's actually protected by the law. Okay, so if the government employers don't pay the money when you're retired, they are considered to be violating the law. Okay, so so this is the defined benefit. It means that you can rest in peace that the money will be there. The government employer will pay you when you retired. Okay? So this is a certainty. Okay. But when you look at the private employees, only 16% they are in the defined benefit. Most are in the defined contribution plan. This is also known as a 401k. When this it's kind of interesting that when you talk about the pension plans, 401k is much more famous. Everybody talk about the 401k. That's because in the private sectors, 401k is the way that the private employers pay their private employees. Okay, so the majority of them, more than 84%, they are in the defined contribution. Again, the key difference is that defined contribution, there's no guarantee. They only guarantee you that they will you will have to deposit money into the 401k account, and then at the end of a retirement, at the end of your career, when you retired, you get that money. And sometimes a lot of employers will match the contribution. So, for example, if you deposit $1 each month, your employers will give you one more dollars to match that. Okay, so but there's no guarantee. So the key word whenever you hear this defined contribution, it means the money is not guaranteed. You basically get what you put down for, at the end of the career, when you start to retire, you get the money back because the money is you deposit the money into the 401k account. Okay. Again, the key thing is that defined benefit. That's for the public factors, public employees. Defined contribution is for private employees. Okay. The nice thing about the defined benefit for public employees is that they are protected by Pension Benefit Guaranty Corporation. It's kind of think of this as like a FDIC. Okay, when the money that you put in the bank will be guaranteed by the federal corporation, the company. It's the same thing for the defined benefit plan. The money is guaranteed. If not, then this PBGC will pay you. Okay, but defined contribution, no guarantee. Okay. Okay, here there's a very important difference that how the public pension plans are funded. So where is the money coming from, basically? When you ask this question, we have to look at the history, but also look at the today. Okay, so historically, the way the public pension plan is funded, it's funded by general revenue. Okay, general revenue is basically pay as you go because each year the government has revenues, right? Like a federal income taxes and a state income taxes, and the city government they also get taxes. That taxes is entered a account called general revenue. I mean that the data taxes will be covered, will be covering a lot of different purposes. Okay. Um, but data revenue is collected each year because we pay tax each year. So in the old days, historically, we are using the tax money to pay the public pension retirement. So that's old ways, old days. It's not a good way because we now have a better way to do that. Okay, but here pretty much since the 1980s, we switched into the pre-funding. The dominant mode is pre-funding, meaning that you don't pay by the general revenue, by tax money. Instead, you save the money, and then the money will be contributed by the employers and the employees, and then that money will be put aside, and then also not just put aside, but also invest into a financial market to earn money. Money earns money. So this is a much smarter way of doing this. Okay, so this change is basically brought by a law called ERISA, which is Congress passed in 1974. It's called the Employee Retirement Income Security Act, ERISA. This is a milestone. This law is a very smart way of to fund the public pensions because they ask you to not to no longer pay by general tax revenue money. You have to put the money aside. So that's why ever since the ERISA law passed in 1974, beginning that in 1980s, all the government, the state government, the local government, they follow the rules set up by Government Accounting Standard Board, GASB. Okay, that created in 1984. So today, that's how things works. We are no longer paying the pension benefit by the general revenue money. Instead, we are using the contribution, investment, and distribution, the three steps that I mentioned, and those rules are all set by GASB. Okay. And then here we have GASB. One of the rules says that the GASB has to ask all the state government and local government to have actuarial evaluation. Actuarial basically is a kind of people think of them as statisticians. Their job is to find out how much money will be paid in the future. So correspondingly, so that's what we have to get the future asset. How much money you need to have for the state government and local government to have in the future, and then based on this future asset, then you have to figure out the liability. How much is need to be paid to the retired employees, former employees, and then because this is estimation, right? So Gatsby says that actuaries will make estimations. The estimations were based on two kinds of assumptions. One is a demographic, and another is economic assumptions. What is the economic assumptions? Basically, it's about things about the interest rate, financial market earnings, and salary changes. What about the demographic assumptions? Those are the things like how long you will serve for average employees, and what is the turnover rate? People may quit the job, people may leave, right? And what is the mortality, meaning that how long people can live, and then what's the age when they retire, and then the possibility for them to get disabled, while you work. So all these kind of things will be figured out by the actuarial. So you can imagine their job is very important, right? So based on actuarial, based on the how much money need to be prepared for the future in order to pay the liability, meaning the pensions, and then based on that, they decide how much contribution you need from the from employees, and from employers, most likely employers, right? And then here, this is the key issue that we will be talking about. It's called the pension unfunded liability. So let me stop here at the first part, and then we'll get to this. The second is more technical issues later. Okay.